It is Cowboy Metals live for February 8th, 2022. Everybody, welcome to the program Cowboy Metals Live, where we broadcast from the great state of Texas and we take no BS. This is your host, Rob Keats, bringing you the best on the gold and silver market. And the title of today's show is Live, Why Options Position Limit Changes for Gold or GLD and SLV are Dangerous. We're going to be talking about that on the show today. And the purpose of that is to discuss the latest scheme that the manipulators on the markets are using to control the price of gold and silver. And this is going to seem somewhat pessimistic to those of you who may be new to this market, but I believe that the schemes are put in place in order to control it, to facilitate the gold and silver moving to where they need to go to, and further that GLD and SLV, these derivative options, don't offer direct exposure for people into gold and silver themselves, and therefore they are false supply, and therefore act as a absorber for additional gold and silver demand in the markets. We'll get into that in a few minutes. We're going to let people load into the chat. We'll give it a few minutes there. I know that people are just joining the show. I'd like to welcome everybody in. We are doing our lives now on Tuesdays, usually at 5:30 p.m. Central Time, 6:30 p.m. Eastern Time. Happy to have you guys on the show. Thank you for joining. We'll continue to let people load into the live stream before we get into the content. I did want to remind people that yesterday we did put up a basically a mashup or the highlights of our 2022 Metals Kickoff Conference that we had on Wednesday, January 26th from 1 to 6 p.m. Central Time. Had a lot of fun, had a lot of guests on the show, had a lot of people engaging and joining us. We also had a live chat with myself and a lot of the other analysts and companies in the last hour of that conference. We'll be running those quarterly, so the next one will be in late April. We'll put details on the channel for you guys if you want to join. Thank you, Scott Cole, for the contribution. We appreciate that. If you have a question, throw it up there and we'll try to answer it for you. Remember, live chats are available, or super chats are available down there if you want to ask a question. Grabs my attention as I'm looking at the screen. Of course, I will try to jump into the chat and answer any of the questions that I see as well. Remember, on our lives, we do have a Q&A session in addition to the content that I'm bringing you. And today's content is basically a deep dive into the proposed option changes for GLD and SLV and how that is dangerous, hence the title of the program. Evening, everyone. I see Ralph Potts is here. Cheshire Yeoman is here. How you doing? John Wilkinson is here. Neil Hahn is here. Tom Stencil is here. I saw Sarge in there at the beginning. Welcome, Sarge. And welcome to everybody else that's joined the program. Appreciate everybody for being here. We're going to give it another minute for people to load into the chat. We get enough in and we'll talk about the topic. Also a reminder, if you go to the webpage and click on the newsletter button, you can enter your email, your name and email there, and we'll send you on Mondays an absolutely free to you digest of all the content we had the previous week, plus some new information for you. It's an email newsletter. We won't spam you. We'll just email you once a week to let you know what's going on in case you missed anything and to provide some additional insight into the market. Welcome EC660 to the program. Wildcat7 is here. Cheers, stackers, he or she says, and I agree with you. Cheers on the stackers. All right, guys, we're going to do it. We're going to jump right into the program. It's why position limit changes for GLD and SLV are dangerous. I have to thank one of our subscribers and viewers for basically turning me on to what the markets were trying to do and the proposed rule changes to the exchange. The proposed rule changes have been withdrawn, so they're not going into place, and I'll explain why that probably occurred. But it's helpful to understand the scheme, to understand what it would probably do and how potentially dangerous it was. That's why we're going to go through it, because at the end of the day, I don't think people that are trying to manipulate the market up and down, or control, if control is a better word, if you want to use that one, they're trying to control the market up and down for their purposes, whatever that purpose is, market price stability or getting the metals cheaper, whatever the case, protecting their options positions, whatever the case may be, I don't think it's going to stop. However, that's my opinion. I did put up a poll, guys, asking that very question. The poll says, is the end of manipulated paper schemes to control spot metals prices? Is it over? Or is more to come? 26% so far say yes, 43% say no, 30% say it ends in 2022. We got a little definitive with that last one. It ends this year. So almost half say no, the rest, a little over half, about 40, well now about 60% say it will end either in 2022 or overall this is the end. So interesting, you guys go vote in the poll. We've already got 25 votes in there. we're going to jump right into the presentation. I'm just going to take you straight to the documents that basically were put out asking for comment, if you will. But I first want to give credit to the gentleman that brought this to my attention. So as you can see on the program, 𝙈𝙀𝙏𝘼𝙎 CFA on Twitter, that is his handle, says, I really had to dig for this one, but there are some big things going on behind the scenes in the GLD and SLV markets. What do you think the implications are? And clicking on this link takes us to the proposed rule changes, which is what we're really going to be talking about today. So that's what I wanted to highlight for you guys. So I'm going to put as much of this detail on the program as I can and talk about it. It's a 30-page document. I'm not going to get to everything, but I'll get to as much as I can. If it warrants it, as I go through the rest of the document on a second and third read, I feel like we need to do another show on this, we will. But I'm going to cover the major points. So starting off on page 1, basically the title of this is right here on sec.gov, as you see. Securities and Exchange Commission release number 34-93831, if you want to look for that. And the file number is this. If you want to look for that, you can find it yourself, or simply click, take this URL, type it into your browser, and you can find it. So pursuant to Section 19B1 of Securities Exchange Act of 1934 and Rule 19B4 thereunder, notice, so this is the current rule enabled by this legislation, the SEC, or Securities Exchange Act 1934. The CBOE exchange, which is the exchange that handles all of this trading, the options, filed with the Securities and Exchange Commission the proposed rule changes described in items 1, 2, and 3 below, which items have been prepared by the exchange. The commission is publishing this to solicit comments. And I'm just going to come down to page 2, and I'm going to show you the purpose section. And right up front, they basically tell you what the risk is of the change that they're proposing. Okay, they're going to come right out and say what it is. And what are they proposing? They're proposing to change the limits on options positions from 250,000 to 500,000 per participant on the exchange. So an option is basically you pay a little bit of money for the option to go short or long on an underlying position. In this case, it'd be silver and gold, or GLD and SLV specifically, not silver and gold, but GLD and SLV, the funds, to control 100 shares of that. So each option contract controls 100 shares. So it's leveraged. And you don't put up all the money, you only put up a little bit of money to take a position for the chance that if the GLD or SLV share price moves in your favor, whether short or long, you can make some money on that. In other words, it's a way to take a leveraged position on price, in this case the GLD and the SLV funds, using a little bit amount of money to make more money. It's basically a little bit of gambling, if you will. That's what an option is, much like a stock option. So it says right here, position limits are designed to address potential manipulative schemes and adverse market impacts surrounding the use of options, such as disrupting the market in the security underlying the options. Now they're admitting that there are manipulative schemes, and that's why position limits were put into place. Anybody who says markets have not been manipulated, it's right here in a document at sec.gov put out by the exchange. While position limits should address and discourage the potential for manipulative schemes and adverse market impact, if such limits are set too low, participation in the options market may be discouraged. The exchange believes the position limits must therefore be balanced between mitigating concerns of any potential manipulation and the cost of inhibiting potential hedging activity that can be used for legitimate economic purposes. Okay, so let's talk about this, for example. What is the main hedge against gold and silver prices? That would be the futures exchange in COMEX. There's also the London OTC market, and GLD and SLV are not considered the frontline hedges for gold and silver. The frontline hedge for gold and silver here in the U.S. is the COMEX, and that is going long or short the gold. I believe it's 100 contracts of gold, or 100 ounces of gold and 5,000 ounces of silver. You can go long or short those. That's your hedge. That's what the producer merchants use. If you look at a commitment of traders report from the CFTC, which is a regulator, Commodities Futures Trading Corporation, or Commission, they basically put out the commitment of traders report. And if you look at the number of net longs and shorts, it dwarfs the amount of production in a 3-month period of time between those dominant contracts. So meaning if you took a futures position a couple 3 months out on gold and silver, you're basically hedging a price for 3 months at a time. but the aggregate size of all those positions on the exchange is much more than the gold and silver actually produced by the miners. Why does that matter? It means it becomes a gambling market, not a hedging market. In other words, the COMEX handles enough hedging already for gold and silver price, and even a lot more, and you don't need, ladies and gentlemen, to hedge anywhere else. So the fact that they're saying that you need to hedge gold and silver price with an option on GLD or SLV rings false. There are other hedging vehicles, and if you want to gamble on GLD and SLV, which are derivatives not leading to direct ownership of gold and silver for the vast majority of participants in those funds, you're hedging a derivative, not gold and silver. So who gives a flying crap? If GLD and SLV price go to 0 or go to 50 trillion, it doesn't actually affect the gold and silver price. Now, they're supposed to, the share price should be indicative of the actual gold and silver price, GLD for gold and SLV for silver. And we know that it can be higher or lower depending upon trade. And all you do by increasing position limits of options against GLD and SLV, those derivatives, is offer the opportunity for more market manipulation of GLD and SLV. In other words, the deviance from what they should be according to the gold and silver price. In other words, it's a leveraged gamble on a derivative of gold and silver. But you already have derivatives of gold and silver itself in the futures exchange and the futures and the options exchange on COMEX. You already can do that with the OTC London market. Why do we need to increase the position limits of GLD and SLV? It doesn't make sense. You're increasing the potential speculative manipulation of derivatives of gold and silver, not even gold and silver itself. And it gets really interesting later in the paper as we address the reasoning for why this makes sense. I don't think people are hedging gold and silver physical using GLD and SLV options a whole lot, because if they are, it's silly. Why don't you just go to COMEX and use options and futures there? And options aren't your primary hedge anyway. It should be futures positions. Options, yeah, it does give you exposure, but it's more of a gamble. And again, the COMEX already has more options and futures derivative trading than the entire gold and silver market produces in a year. So it's not legitimate hedging, it's speculation. So why would you increase position limits, therefore, in that market, much less the GLD SLV, which are themselves derivatives of gold and silver? None of this makes too much damn sense. But let's go back and we'll notice something else on page 2. Okay, I only had to go through about halfway through this document before I figured out this is ridiculous. I did read the whole thing, but I really focused on the first 8 or 9, 10 pages of a 30-page document or 26-page document because it's silly. The whole thing is abject silliness. Now, it did get withdrawn, but it shows you the lengths that they're going to use derivatives to control other derivatives to control gold and silver. It's gotten really ridiculous at this point. All right, read this very long and very revealing paragraph. Okay, it says, the exchange has observed an ongoing increase in demand for both trading and hedging purposes in options in GLD and SLV. Though the demand for these options appears to have increased, position limits for options of the underlying ETFs have remained the same. In other words, there's more volume trading of the options on GLD and SLV, but the position limits haven't changed. So they're saying, well, if there's more trading, you got to raise the individual position limits. It doesn't necessarily mean that it hinders each individual participant. There may just be more participants in GLD and SLV options, and they don't really explain that in this paper. They only talk about the top line number. They don't break down how many participants are in, so they don't really give a good reason for changing the individual position limit. You have to talk about how many participants and how much trade's going on per participant to really justify whether individual position limits need to be changed. They don't do that in this paper. Though the demand for these options appears to have increased, position limits have remained the same. As I said, the exchange believes these unchanged position limits may have impeded and may continue to impede trading activity and strategies of investors, such as use of affecting hedging vehicles or income-generating strategies. And the ability of market makers to make liquid markets with tighter spreads in these options, resulting in a transfer of volume to the over-the-counter markets. Okay, first of all, this is stupid. Because people, if you're hedging your exposure to gold and silver on GLD and SLV, you should have done it in the futures markets anyway. That's why they're there, and there's already more there than actual mine production. So then you assume that you're hedging your position in actual physical gold and silver. Okay, fine. I still think that the COMEX market is enough for the London OTC if you want to take a position there. Why would you do it on GLD and SLV? Why would that become What they're really saying is, if you read between the lines, there's pressure on the London OTC market, and what they want to do is release that pressure through bringing trade over to GLD and SLV, which is yet another derivative on gold and silver that don't actually represent physical gold and silver. At least from a shareholder perspective, you can't get it unless you're a really large shareholder or an authorized participant. Continue to read on. OTC transactions occur through bilateral agreements, the terms of which are not publicly disclosed to the marketplace. As such, OTC transactions do not contribute to the price discovery process on a public exchange or other lit markets. Okay, first of all, this is absolute BS. Any person will tell you that the gold spot price is determined by a combination of the OTC market and the London fix, and then also the trade on the COMEX. So what they're saying here is the London market doesn't contribute to price discovery, when that's the whole justification for the London market OTC market to exist, because they set the spot price along with the COMEX. I've argued that the COMEX has taken the lead there because the data is more visible, and that's what this paper argues. But they're saying the opposite of what the London OTC market has always said, which is they play a big role in determining the spot price. So get your crap together. Which is it? Does it or does it not? See, the participants don't even agree. That's how convoluted this stupid piece of crap paper is. Okay, I'm sorry, it's crap. Therefore, the exchange believes that the proposed increases in position limits for options in the underlying ETFs may enable liquidity providers to provide additional liquidity to the exchange and other market participants to transfer liquidity demands from the OTC markets to the exchange. Why in the hell in gold would you want to transfer liquidity or derivative pressure? Because we know the OTC market is not backed up one for one with gold and silver. We know there's more contract positions than there are metal and gold, gold and silver. That's why they're derivatives. Why would you want to transfer in December 2021 pressure off the London OTC market to the GLD and SLV? Because, ladies and gentlemen, Basel III. In London, Basel III takes effect right now at the end of January. That's why this was proposed in December, 1 month before. They were trying to get it through to take pressure off that OTC market because Basel III requires them to back those derivative positions 85% with legitimate assets, whether it be gold or something else, high quality liquid asset as defined by Basel III, NSFR. Okay, so they don't have it. So I think one of the reasons for this paper was to take the pressure off the London OTC market because of Basel III and stick it on GLD and SLV, which are derivatives of a derivative and shouldn't and don't determine gold and silver price. They wanted to take what should be a legitimate market OTC, which I don't think it is, and transfer it to an illegitimate one so they could play games over there and affect the price and take the pressure off the bullion banks and their positions in the OTC. Sorry, Charlie, didn't work. This got rejected. But you can see they're very explicit in the paper what they're trying to do, and I think the reason is because of Basel III. I think they're trying to run a scheme to take pressure off of Basel III, and it didn't work because it got rejected. We'll talk about that in a second. As described in further detail below, the exchange believes that the continuously increasing market capitalization of underlying ETFs, ETF components, as well as highly liquid market for each, reduces the concern. So they spend almost the rest of the paper talking about how liquid the ETFs are. I don't give a crap how liquid the ETFs are, because it has nothing to do with the reason why you're doing this, but we're going to talk about it. So let's talk about position limits on page 3. This is page 3. They want to move from 200,000 to 500,000. Now, ETFs have varying position limits depending on the market, 200, 75, 50, or 25,000 by rule dating back to the SEC Exchange Act in 1934. They're saying for GLD and SLV, it needs to go from 250 to 500. They want to put it at 500 right here. And then this is where it gets really goofy. They pull 4 or 5 funds that are trading on the exchange that have jack diddly squat to do commodities or metals markets and use as an example why you should increase the position limits to 500,000. They start with the MSCI Brazil capped ETF. What in the name of Zeus's butthole does the MSCI Brazil capped ETF have to do with gold and silver? I don't know. Let's go look at it. It's exposure to large and mid-sized companies in Brazil. What the hell does that have to do with commodities and metals markets? Absolutely jack diddly squat. Okay, let's look at the next one. The 20-year treasury bond. I don't even have to look that one up. What does the 20-year treasury bond market, a very large and liquid market, have to do with GLD and SLV or gold and silver? which GLD and SLV are supposed to basically mimic the value of on a share basis. Sorry, doesn't work. The iShares MSCI Japan ETF, let's see, that's access to the Japanese stock market in a single trade. So it's basically like a derivative of the American S&P, but for Japan. Okay, again, what in the name of Zeus's butthole does that have to do with GLD, SLV, the London OTC market, the COMEX, or gold or silver metals? Jack Diddley Squat. The iShares Box High Yield Corporate Bond Fund, okay, we'll talk about the bond fund. It's $432 billion itself. Yeah, what does that have? It's a big market. What does that have to do with gold and silver or GLD and SLV? Nothing. Or the Financial Select Sector SPDR Fund, the XLF. What is the XLF? The index seeks to provide effective representation of the financial sector of the S&P 500. So they're taking the financial sector S&P 500 and they're saying, well, they trade 500,000. What does that have to do with the price of tea in China? What does that have to do with GLD, SLV, the London OTC market, the American COMEX, or anything else having to do with any metal or commodities market? I will tell you the answer to that question is absolutely jack freaking diddly squat. Okay? Nada. Zippo, zilcho. I will tell you that. Zero. Okay? Nothing. This is goofiness. It's absolute goofiness. They're grasping for straws. That's why it's rejected. But this is the lengths they're having to go to continue these schemes. All right, now I'm going to give you a second to absorb all that. I'm going to take a breather. We're going to go deeper down. I got more stuff to talk to you about. I've got to talk to you about repeated warnings, size of daily volumes, other fund markets are different from gold and silver, which they admit, which is absolutely stupid. Where they're saying it's backed up by world reserves, and they're actually talking about metal in the ground and not actual tradable metal because they admit they don't know how much tradable metal there is. I mean, all sorts of goofiness in the paper. If you guys got questions, go ahead and put them down there. Appreciate you guys. Do the super chat if you really want to grab my attention, and I'll try to come back to this chat and talk about. Let's take a look at the poll before we go further into this paper. Give everybody a breather. Let your brain settle on that. Is the end of the manipulated paper schemes to control spot metals prices, or is there more to come? According to the poll, 56 votes right now, 29% say yes, it is the end of the manipulated paper schemes. No, 41% say, and people are definitively saying 30% it ends in 2022. All right, Steve Ross has done a super chat. Thank you, Steve Ross, for your support. He says, my take. ESG leads this year to major food and energy shortages, inflation, market economic crash. ESG created Destroy West, initiate Great Reset. I think ESG is a part of the reset. I don't think it's necessarily the only trigger mechanism. I do think environmental social governance programs are to funnel money into schemes used to control industry. Now, nobody would disagree with that. People want to say that it controls it for good reasons, and I think there are actually good parts of ESG. It's encouraged some good behavior, especially in mining. But does it go overboard and have way too much control? Is it overdone completely? In my opinion, in a lot of areas, yes. I do think environmental and social governance are good, but when you base it on sketchy science and you try to control entire markets with these initiatives, I think it's too much. And I think it needs to be re-examined, the impact it could potentially have to markets. I don't think it's going to cause, in and of itself, the Great Reset. I think the Great Reset was coming for other reasons, but I do think it's a part of it. I do think it is a scheme designed to essentially control through government mandate how companies can do things and to pick winners in industry, even if you wanted to. It could be used for that. I think that's the potential impact of ESG. Good question, Steve. We're going to go back to the share guys and talk more about this paper. So right now, I am going to go to, I think we're, page 4. Now they do another warning on page 4. Let's talk about that. I'm on page 4. They said, as stated above, and they warn again how options can be used to manipulate the market. For anybody who thought that there was no manipulation, they're saying to the SEC, oh yeah, it does. As stated above, position and exercise limits are intended to prevent the establishment of options positions that can be used to or potentially create incentives to manipulate the underlying market so as to benefit options positions. The Securities and Exchange Commission, the Commission, has recognized that these limits are designed to minimize the potential for many manipulations and for corners and squeezes of the underlying market, as well as to serve to reduce the possibility for disruption of the options market itself, especially in the liquid classes. Blah, 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 blah. They admit, the SEC, according to this paper, And the authors of this paper admit options can be used for manipulation. What do we talk about on the derivative markets all the time? It's right here. They'll only admit that when they want to use it to do something they want to do. They won't admit it in general. If I go on YouTube and I say options and futures can be used, and the OTC market can be used to manipulate gold and silver, I'm called a crank and a conspiracy theorist. It's right here in a fucking paper from the SEC. So I'm tired of hearing that, basically. So shut the hell up, basically. Stop telling me they're not manipulated. The SEC and the CBOE have admitted it in a paper. All right. Page 9. Let's go to page 9. So here are the sizes of the markets. This is actually page 5. I wanted to point out real quick. I'm going to do this real quick before I go to page 9. Here's the volume, the average daily volume. 12.3 million shares of GLD traded today, 33.1 million shares traded today in SLV. If you take the amount of shares controlled by an options contract, it's 100, and multiply, you get 25,770,000 shares controlled, can be controlled by the options contracts. That's more than the shares trading today. So options is already bigger in silver, and they want to propose individual position limits be moved doubled. That would offer even more control over the daily market in GLD. That could be highly manipulative. What about in SLV? It'd be 37,670,000. That's more than the average traded daily volume before the position limit change from 250 to 500. So obviously, if you're doubling the size of individual position limits, that person only doing 500,000 positions probably couldn't change the whole market or do a big manipulation, but get a few people together, and you could, because there are already more options than the daily trading volume of the actual shares anyway. So yes, the options already are bigger than the number of shares, and yes, it can control the position, and that's what we talk about, the big 4 and 8 banks controlling the futures positions on COMEX. Could they not do the same thing with GLD and SLV? Now, why would you want to control the price of GLD and SLV? Let's talk about silver squeeze for a moment, ladies and gentlemen. Let me stop the share and let's get real here for a minute. We're going to get really, really real. So essentially, at the end of the day, what happened in SLV the last 2 days of January last year, 2021, and the first day of February 2021, were that 110 million ounces of silver demand came from the silver squeeze movement into SLV, into that derivative. Okay? The London and the silver is stored on the London OTC market. So think about them shifting from the London OTC over to GLD and SLV. In gold, they want to do it, I think, for Basel III. In silver, they want to do it because they're afraid of another silver squeeze. The SLV stores its silver in the vaults in England. They admitted, the vault operators admitted, that if that silver squeeze in SLV had gone on for another 3 to 4 days, they would have been bankrupted of all available silver in the London OTC market. They came out in a disclosure we talked about a month or two ago. So for gold, I think it has to do with Basel III. For silver, it has to do with the illiquidity of the London OTC market, and they're afraid of silver squeeze part 2. It scares the absolute crap out of them. That's why they're proposing this rule. I think if you read between the lines, that's what this is all about. Woo, man, we're just buzzing along. Okay, we're going to go back to the share. This paper is really long. Again, I'm not covering every single page of it. I'm going over some of the relevant points I saw in the first 10 pages. On read 2 and 3 of the paper, of the last 20 pages, if I see more goofiness, I'll do another show. Or maybe I'll just throw a Twitter out, summary, depending on what else is in there. But there's so much crap in here about how the markets actually work and how they're controlled in the first 10 pages. It's like them admitting the whole damn scheme out in public and hoping they don't get caught. But guess what? They got caught. Because a guy that follows me on Twitter who purports to be a CFA, sure he is, I'm sure he is, but on the Twitter, his handle is CFA, Doug. Okay, so this is Daniel Vigario part 2. This is another CFA that follows us. Dan Vigario helped us expose the Perth Mint fractional reserve scheme. This gentleman is helping us expose the fractional reserve scheme on GLD and SLV. I love guys that follow me that have these types of qualifications to do this, because it really adds a lot to the discussion when people with these type of skills essentially are helping us do it. Okay, back to the share. And again, this was 𝙂𝙊𝙇𝘿, CFA. Okay, so go follow him on Twitter. Great post here. Lots of conversation in this post, by the way. I retweeted and said, hey, I'm going to put this on the show tonight. So, all right, now going down to page, let me guys make sure I'm actually on the right thing. I'm gonna go back and check the video, make sure, okay, I'm showing you the right thing, just make sure. I have new streaming software, so double check, make sure you guys are seeing what I want you to see. So now we're gonna go down to page 9. 6, 7, 8, 9. Where they admit that the fund markets are different from gold and silver. See if it's on this page. All right, here we go. Also, as detailed above, the exchange believes that the average daily volume share and option volume for the overall value of GLD and SLV, particularly as compared to across other ETF options, and position limits currently set at 500,000 contracts, are large enough to absorb potential price movements. I call hooey, but anyway. And it does mention here, are large enough to absorb potential price movements. It recognizes that here's the important part. The exchange recognizes that the spot metal markets underlying SLV and GLD, now they're talking about COMEX and OTC. Why? Because those are the fucking spot markets. Listen to what they say. Differ from the equities markets underlying these other examples, the ones that I showed you, this garbage that they're trying to compare to. They basically admit they use these as examples, and like me had the same thought. This has nothing to do with anything gold and silver, and we're going to admit that in the paper. However, we're going to say, well, even though we admit it has nothing to do with the price of tea in China or gold and silver, we do not believe these differences warrant the position limits options for GLD and SLV to be half the size of position limits of these options. In other words, we have 4 or 5 random funds that have higher position limits, that have nothing to do with commodities or metals markets. They're, in some cases, much bigger market, like the treasury market and the bond market. But don't worry about that fact. We still think it's legitimate to increase options positions on GLD and SLV. Huh? You said in one page, I think page 5, where you said we should do it because of these funds, and then you say on page 9, well, it really has nothing to do with it, but we still think you should do it. This paper is full of contradictions and ridiculous lack of logic and stupidity. No wonder it got rejected. I'll show you the rejection in a minute. It's just stupid. I don't understand. I don't get it. Okay, now, here's where it gets really goofy. Okay, they're talking about reserves. Now, those of you in mining or in the mining stocks or follow mining at all know what a reserve is. A reserve is a proven and probable ounce. In other words, there's enough drill holes in a field of gold and silver, copper, lead, tin, whatever, that you get to the proven probable category, which is the highest quality that you can put in a 43101 technical report indicating reserves. In other words, that's probably what you can get out of the ground if you go mine it. It doesn't mean that the mine is ready to mine it or that you can get it to a mill or anything like that. It's just in the ground. It's had a feasibility study. Listen to what the exchange says, is backing up their proposal that we increase options positions on GLD and SLV. This is stupid. The exchange reviewed the amount and value of the gold and silver reserves estimated to be held across the globe, as well as the amount of value held in the London vaults, compared with the amount of value of open interest in SLV and GLD. Amount of gold and silver reserves. Let's go, ladies and gentlemen, to the U.S. Geological Survey. Reserves are what the mines have, world mine production and reserves. In the ground, they haven't even gotten out yet. Silver, gold, bam, reserves. Okay, yes, the reserves that have not come out of the ground yet would probably cover liquidity in GLD and SLV, assuming that the COMEX and London OTC market aren't hyper-leveraged and those reserves are already spoken for in those derivative markets. The problem is, when the hell are you going to get the reserves out? A reserve just says we've done a feasibility study. It doesn't say in the next 5 years you're actually going to get it out of the ground. What this is doing, these options position, would be allowing them to control the value of GLD and SLV on future production of gold and silver that hasn't even come out of the ground yet and is not liquid. That is absolute garbage. Okay? That's the type of crap that the Perth Mint did when they sold gold and silver forward of the actual gold and silver they had. One, they loaned out gold and silver to a large entity. And two, they sold forward production they hadn't even gotten in yet. And it wasn't in working WIP or working capital or working. It was proposed to be received at some point. That's what the Perth Mint did. This is a Perth Mint type scheme now in GLD and SLV. part two, permit part two, but in GLD and SLV. If you guys are investing in GLD and SLV and you see how they propose manipulating it and how they're already manipulating it because the average daily volume of the option is actually more than the actual shares themselves, dude, why are you in the GLD and SLV fund? It's absolute lunacy. This is crap. You don't want this. Get the metal in your hand. Get the metal in your hand. Oh my goodness. All right. Now, in page 12, they admit that they don't know how much gold and silver is liquid on the OTC and COMEX. I'm not going to read this one for you. Frankly, I'm getting tired of reading the paper. But it's in the paper. They admit, oh, here it is. Which stated does, well, I'll read the sentence. As such, even this hypothetical unlikely event occurred, and you can read the event, it's that the options overwhelm the gold and silver liquidity. It would impact only a negligible portion of the world's gold and silver reserves, a fraction of the gold stored in London vaults. It does not account for the total amount of LGD bars available globally, nor amount of reserves readily at hand. The exchange understands that market participants use options to hold a leverage position. In other words, they admit several times in the paper they don't know how much gold and silver is in the London market. They don't know how much gold and silver is on COMEX. You can read the paper. And so all of the assumptions in this paper are absolutely crap. Now, on January 26th, it got rejected. Why? Because this original paper was for comment. It's like, give us your view on this proposed rule change and whether, we should do it. Less than a month later, rejected. On January 24th, the exchange withdrew the proposed rule change. They say it was withdrawn. I say it was rejected because anybody who follows these markets is looking at the reasoning in this paper and saying, this is absolute freaking garbage. What the hell are you doing? And okay, I gave you what I think are the core reasons why they're doing it. That's my opinion. Go read the paper, guys. We'll throw the link out there. It's on Twitter already on our channel. We'll throw it out on YouTube as well. You saw the link up on the, live on the live broadcast. But they're not going to stop trying to do this. Now, are these manipulative schemes going to end this year in 2022, as I put in the poll? I don't think they will, but I think they're getting more desperate because you're becoming sillier and sillier and less reasonable. So I think they're running out of straws. I think because of Basel III, I think because of silver squeeze, all of those things are affecting their ability to run these markets, these leverage markets, in the way that they were to control the price. And it means they're starting to lose control of the prices. Long term, that means higher prices, gold and silver, I believe, in my opinion, because I think most of the non-hedging positions are short in the other markets, the COMEX especially. And I talk about that all the time on the COT report from the CFTC. So I do think there are signs they're losing a little bit of control. They're getting more desperate. This idea was withdrawn. I think rejected. I'll use the term rejected. They say withdrawn. I think everybody took a giant crap on it and said, okay, this is way too obvious and silly, and you don't have the right data to back this up. And so I do think that puts the London OTC market in trouble. I do think it puts SLV, which holds their silver in the London OTC market, in trouble, or in the vaults. I do think that means that we're over leveraged to gold and silver on the COMEX and London, the two biggest derivative markets. And I do think that this is interesting information. I want to bring it to you guys. And thank you for the CFA that put that up and tagged me on Twitter. I would never have found that. It's buried in a bunch of documents. He just went splunking and found it. But it shows you what they're going to try. They're going to keep trying this stuff. But it also shows you they're a little bit more desperate, I think. All right, Dominic Media says, yo, Rob was wondering, for the 10-year 2% is in danger zone. Was a danger zone for the 30-year, or is the inversion the only thing that matters? In my opinion, the big event is the inversion, because the inversion almost always predicts, with one little exception, over the last, I don't know how many years, 60, 70 years, always predicts a recession. That's what I care about the inversion. When it inverts, it means short-term, people are more worried about risk than they are long-term. And I think that's when, and the bond investors are really smart in that they look at tons of data, and they'll see risk before the stock market and before other people. I won't call bondholders smart because they're holding debt, which to me is not an asset, it's a liability, but they do follow the market. So when you see that yield curve invert, and the 2-year is higher than the 10-year, it's telling you immediate risk. Danger Will Robinson in the debt markets. And that usually prefaces, almost always, 90-something% of the time prefaces a recession. So I think that yield curve is getting closer to inverting, and I think if it stays inverted for at least a couple of days, then you're predicting a recession, in my opinion. And that's if you believe that those markets aren't manipulated, that the Fed is not controlling that yield curve, which they pretty much said in every meeting minutes that I can remember reading that they're exactly trying to do. They're trying to control the yield curves. So it's manipulated. So it's possible that in reality, those yield curves may have, in more real world terms, inverted, but the nominal print, since they're manipulated by the Fed and they're purchasing U.S. Treasuries, is probably disguised, is my opinion. Thank you for the question, Dumb Money Media. All right, final readout of the poll, guys. We're going to end this up here in a few minutes. Is the end of manipulated paper schemes to control spot metals prices, or is more to come? Is it the end, or is more to come? 40% say no, 29 and 31% say yes, and sometime in 2022 or sometime thereafter. Thanks, guys, for answering the poll question. We're going to go ahead and end the poll so we can get that printout of the official results. You can see it there in the chat. Boom, there it goes. Let's see. Let's fit any other questions in the chat real quick before we get ready to sign off. Sarge says that's why we need Rob to figure it out and let us know the how-tos. Thank you, sir. Peter Frohine, new channel moderator. Congrats to Mr. Peter. If you don't hold it in your hand, you don't own it. I think that's a pretty damn good. What we saw here today was a pretty damn good argument for that. Sarge says they tell you all the time to your face about everything. You just have to look. That's right. You have to have CFAs dig through this stuff, dig through the Perth Mint, and dig through these documents on the SEC to find this crap. Because guess what? It's not on mainstream media. Where are you going to come to get that info? Right here. Thank you very much. You're going to get it right here. Any other questions? Miles Nelson says, how does a reduction of imports coming into the U.S. affect physical PM supply? Will that supply disruption affect the paper market? Not the paper market, but the actual physical trading. Remember, the paper markets won't blow up until the physical market seizes. That's why silver squeeze and gold squeeze type of concepts are important. And I do think that we're seeing a vast reduction in available silver in the U.S. I've talked about the available register reserves and COMEX a bunch of time. Go watch previous videos. I'm not going to explain that here, but I explained it probably 25 times in the last year, and I did a video on that within the last week or so. Maybe it was last week's live. So it won't affect until the paper markets collapse, but I think what you saw today is a sign that the paper market and the derivative markets are closer to collapsing. Not maybe tomorrow, but closer. It's a milestone and an important one. And their schemes are running out, and they're going to have to get even sillier and more transparent. But it's up to you guys, the followers, to help me find this crap and go share it with everybody else. I dig all day long, but I thank you to all the CFAs and other astute and erudite people who are following this, who report it to me so I can get on the channel and share it with you. I appreciate everybody. All right, good question, Mr. Miles Nelson. Any other last minute questions? Scott Cole with the super chat, thank you, sir, says, my brother is worried about counterparty risk in PSLV. That is the Sprott analog to the SLV. It's not the SLV. It's a Sprott Fund analog, which supposedly, according to their documentation, their prospectus says you have easier access to your metal and it's one-to-one back for metal. I have no reason to disbelieve Sprott, but that's what they say. Can you offer reassurance? Thank you. So I think I kind of did. I think their perspective is more rock solid than the SLVs. Counterparty risk is, you go read the prospectus. It'll go over the risks for you. I think there's a lot less counterparty risk in PSLV, but honestly, I don't invest in it. I'd rather have the metal in my hand or in a depository. I don't really invest in funds that have metal because it puts you one more step away from getting your metal when you need it. And to me, gold and silver needs to be had, not only store wealth, but in times of emergency. So I want to be able to get it. So I have mine stored in all these private vaults that I trust. I keep very little at home. I keep a couple ounces of silver, no gold, because if somebody breaks in, they can have what little I have. I've got it safely stored with custodians I trust, but I can get to extremely easily, or I can turn it to cash if I need to. But it's there where I trust it. A lot of it's within driving distance of me. Some is a little bit farther away. But to me, that's the way I do it. Now, if you want to put in PSLV, of the funds, I think the perspective is a lot more sound in what it says. Is there always counterparty risk with any time that you put your metal with someone else in a fund? Probably, but I think it's a lot less in PSLV than SLV. That's my argument. Of course, be your own financial resource, do your own research. Don't trade on anything I've said today or ever on my channel. That's my disclaimer. Do your own research, contact whatever financial professional you like to use to make that final decision before you invest in any fund, because I'm not a financial advisor and I can't tell you what to do. I only tell you what I want to do. All righty, any last questions? Justin Maxwell says the only thing that doesn't have counterparty risk if you hold the physical, yes, you just have personal risk because you have the physical and you become a target. But I agree, in counterparty risk, it does remove it. I don't think there's any more questions, guys. We're going to wrap it up. Thank you for the Q&A session. Thank you for paying attention to what we had on the show today. It was, in a recap, why options position limit changes for GLD and SLV are dangerous. We went over why they're dangerous. Just the first 10 pages were chock full of just contradictions, misunderstandings of markets, unneeded changes to these existing markets, the risk of the existing markets already. Now it was withdrawn in January of this year because I think everybody took a look at it and said, silliness, not going to work. Don't believe your reasoning. That's what I believe. I don't believe it was just withdrawn. I think it was rejected. Because if it was accepted, they wouldn't have withdrawn it, right? I mean, simple logic there. They put all the time, put together a 30-page paper and put all this gobbledygook in there. Obviously, they wanted it to happen. Didn't happen. So I think it was rejected. But I don't think it's going to stop. I do think we're closer to the end. That doesn't mean tomorrow at 8 a.m. Eastern time, the market's going to open in gold trading at 10,000, at silver at 600. But it does mean from a milestone perspective, we're getting closer. Thank you to the people that do this research and provide it to me. Much like Daniel, this gentleman, and I'll read out his name to you again today. Albert on Twitter provided us this information. I'm telling you, I have the best subscribers and followers in the world. You guys are great. Thank you so much. I appreciate all of your support. Thank you, guys. And until next time, this is Rob Keynes with Gold Silver Pros. You guys be safe. Hug your kids. Kiss your spouses. Spend time with your friends. Enjoy life. You never know how long you're going to have it. Don't stress about this stuff. Let me stress about it and bring you the information and help you. Do some of your own research, but don't stress. Live life, enjoy life. It's short. It's too damn short. And you got to spend it with the people you love and doing the things that you love. Thank you guys so much. Until next time, this is Rob Keynes, goldsilverpros.com.